Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income producing real estate investments. Now, our guest for this week's show is real estate investment expert Bob Fraser. Now, Bob is the co founder and CEO of Aspen Funds. It's an investment firm offering alternative investments ranging from private equity, mortgage notes, oil and gas, and industrial, just to name a few. As CEO, Bob is responsible for financial management, portfolio modeling, as well as building out the systems and processes of the organization. Additionally, Bob is the co-host of the Invest Like a Billionaire podcast, where he dives into the world of alternative investments and speaks with successful investors. Now, on his show, he also discusses economic trends, including megatrends such as inflation, energy prices, and deglobalization. His goal is really quite simple. It's to empower others looking to explore less volatile investment opportunities, improving their portfolio's performance, and enabling them to become more financially secure. And so, guys, without further ado, I'd like to welcome Bob Fraser to the show. Bob, how you
Yeah,
doing
it's great
today?
to be here, Kevin, with you and with all your listeners.
Yeah, excited to have you here, and decided to talk shop. And I know that we're gonna hit a little bit later, but one thing I didn't mention in the beginning, you're about to launch a book as well. It's going to be released here in a few months, so we'll hit on that later on in the show. But let's back it up a little bit, Bob. For those folks that might not be familiar with you, don't know anything about Aspen Funds, don't know your backstory, maybe let's start there and let's talk about your journey into the world of alternative investments, and also
Yeah.
what sparked the idea for Aspen Funds.
Yeah, well, it's a lot of pain. I mean, I started a .com. If you can remember back in those days, of course, you're a youngster, I'm sure, but started a .com, raised a lot of money there, 44 million in venture capital, became the fastest growing business in the Midwest region of the United States in the late 90s. 300 employees, and then lost everything in the .com crash.
Mm.
And then, so I'm dusting myself off, and a few years later, I become a real finance guy at that point. I was a computer programmer prior to that, became a finance guy, but started doing a lot of quant analysis in the stock market and started trading, did very, very well, did some automatic trading systems, some AI systems, did very well. And then until I didn't in September of 2008 is when I officially launched. So after 5 years
Huh.
of doing
Good timing.
unofficial and very successful, as soon as I launched officially, it was like nothing worked anymore. And I lost again the public markets. Well, so I really became, I guess, cynical about the public markets. Right, which is what everyone tells you to stick your money in. And I was looking for something with knobs and dials that I could control, right? When you ever wake up in the morning and the screen is red and you have no idea why and it doesn't make any sense and your stock crashed by 80%, I have. And you have no clue. But you think about an apartment complex, right? Well, you're going to wake up in the morning and all of a sudden your renters are gone. 80% of your renters have disappeared. It doesn't happen. I wanted controls. I wanted something I could control, that I could pro forma, that was more tangible, and that's led me into private alts, and real estate is a great cornerstone, but there's a universe of private alts that are
Hmm.
that are awesome. And having been through four cycles, I'm very unique in that regard, I guess, because I'm still young enough to think, but I have been through four business cycles. And the truth is, everything has its day in the sun and everything has its day of suck. And
Yeah.
so I didn't want to have one thing, right? And sure enough, here, multifamily is, really challenged these days, and everything has its days of challenge, and it doesn't mean it's a bad thing. It just means it's not today. So I wanted to have a multi-strategy approach, right? Where I've got 24 strategies on the shelf, and at any one time I'm working eight of them. You know what
Hmm.
I'm saying?
Yep.
That's the way I wanted to live. And that's really our mission at Aspen is to have a lot of really good things that work, and we're picking the right ones for the time we're in, right? What
Yeah.
what is gonna be good in this season?
No, that's great. I'm assuming when you kick things off, you spoke about multifamily real estate. Was that the first foray into the alt space?
Well, the first was actually distressed debt.
Okay.
So after the great financial
Hmm.
crisis, I meet my partner who we founded Aspen, and we figured out how to buy defaulted mortgages for pennies on the dollar, and we just minted money.
There was
It
a
was a
lot of them.
very inefficient market. Very few people knew how to do it. My partner did. So I became the scale guy, the operations guy, and he was the technical expert, really understood the notes and how to work them and how to run through the traps to work these things. So that was our first thing. And it turned out, and it's a perfect example of great timing, right? There's no one knew what to do with these things. A super inefficient market. You could just make outsized returns for a window of time, right? And these
What was
windows open and then they close, right?
what was up?
I remember in 2013 looking at Miami beachfront condos selling for
Hmm.
$35,000 a pop. You can't buy them for $35,000 a pop
No.
anymore. There's a window in which, and no one was buying them, by the way. No one wanted them. So it's understanding the herd mentality of the markets. Everybody is into the cool investments and out of the uncool investments. Every year something gets cool and something gets uncool. And so I really want to have my finger on the pulse. So I do function as the chief macro strategist for Aspen and speak all over about those. What are the trends that we should be paying attention to right now? And it's honestly, it's our playbook. It's
Hmm.
not just something I talk about. It is I'm actually sharing the Aspen playbook.
So, yeah. So what is that? I mean, we speak about going against the herd,
Yeah,
not having a herd
absolutely.
mentality, and ultimately, I guess the simple way to ask is, I guess, give us the elevator pitch of Aspen Funds and what you do and what type of alternative investments that you're focusing on today.
Yeah, well, it's like I just said. So it is looking. It's data driven
Hmm.
alternative investments. So we're looking at what should be invested in the time we are in now, right? And taking advantage of those opportunities. And you can make outsized returns. I mean, J.P. Morgan made all of his money buying defaulted Russian government debt for pennies on the dollar, and then he got it reperformed. It's like, so understanding the outsized opportunities and seizing those things, and generally their opportunities are there because everyone else is going the other way. For us, I mean, a prime example is oil and gas. Right now, to be a fossil fuel investor, yes, fossil fuels. I said it. You have to put a paper bag over your head, right? Well, that's the time when you want to be a buyer. When you have to put a paper bag over your head, that's the time you want to be a buyer. I remember my daughter telling me, she was getting ready to buy a three-bedroom condo in Kansas City for $65,000 out of foreclosure. And she said, Dad, what if I lose all my money? Three-bedroom condo, $65,000. And I'm like, honey, how much can you rent that for? She said, oh, about 1,200. I said, well, then who cares if Zillow says it goes to zero? Get
Buy
your
as
get
many
your
as you
cash flow.
can.
So, but no one wanted the stuff. There was, you
Yeah,
remember the stuff. You got to put a paper
I
bag
do.
over your head if you're saying you're going to buy condos. And because real estate's toast. And then when your Uber driver is telling you how much he's making in fossil fuels, that's when you want to get out, right? That's when you've picked the top. And so fossil fuels are incredibly there's a very, very powerful false narrative that is incorrect. I'm an engineer by background. I'm not a politician. I'm a data guy. And people are shocked to find out that we are 81% fossil fuels today after 50 years of going green. And in fact, transportation is 91% fossil fuels. 91. There is
Hmm.
simply no replacement for the power density of oil in transportation. If you have to take your energy with you, oil is the only answer right now. I mean, a little bit of cars, but it's not, I can jump on a plane from Los Angeles to Sydney, Australia, a 16-hour flight today, and it's powered by the oil in the wings. I mean, there's no batteries are going to do that. There's no, it's just nuts. We're a long ways away from being truly green, and I wish it were not true. I wish that was a false statement. So
Hmm.
I do. I love our planet. I want to take care of our planet, but I'm also practical. And so
Yeah.
fossil fuels are it's a buyer's market right now. Everyone is exiting the game.
Well, why is it? Yeah,
And
let's
so
talk
it's
about that.
it's a buyer's market, and
Let's
the cash
dissect that a
flows
little bit.
demonstrate it. I mean, we're buying at cap rates of 20%.
And what are we buying? So let's break it down. Let's
Producing oil
dissect it a little bit.
fields.
Okay.
Producing oil fields. This is not, I'm going to poke a hole in the ground and hope something good happens. No, this
Mhm.
is
So it's
producing proven.
not
There's zero
exploratory.
geology risk, zero operator risk, zero engineering risk. It's pure commodity risk. That's your risk you're taking.
That's it. Yeah.
Operated by public majors. And we're buying this stuff at a 20 cap. That means unlevered, you're making a 20% cash flow. That's insane.
And
That
what's
just
the
tells you how hated it is. When you can
yeah?
buy anything at a 20% cash flow that's got little risk on it, you know how hated it is.
And
Now, when the cap rates are 5% or 2% or whatever, then you know it's time to sell. So the
provide
market's
more
always,
context
but
around
that's
maybe
just a
the
perfect example of something that is, has a great mega trend behind it. We're looking for data-driven investments,
provide
right?
more context around the reason for the distress and the somewhat mass exodus out of the oil and gas space, and why you guys are able to pick up these great opportunities at phenomenal prices, just so the
It's really
listeners can better
political.
understand it.
It's really political, to be honest. It's this the narrative is that the world is post fossil fuels.
Hmm.
That's what people believe, that we're about to be green, and there is it's just nothing is further from the truth. The data does not support that. I mean, the EIA, the European Energy Information Group, just said by the year 20, oh, I can't remember the year. I think it was 2030. We were going to see a 25% reduction in fossil fuel demand. I'm like, what? From where? I mean, there's no data. I mean, it's pure pie in the sky. It's political wish, it's wishing, and it's just ridiculous. But that's led just to a huge exodus. The world believes that we're post fossil fuels. And what's happened is investment in fossil fuels globally has dropped 65%, meaning oil and gas exploration. Now that really matters because oil is a diminishing resource. So we must spend. We're seeing 5 to 7% production declines every year from existing fields. That's just natural. Nothing's wrong. That's just the way it is. You have to replace that. In order to maintain flat production, you have to replace that with exploration and development. It's not happening. And so there's a brewing energy crisis. I can't tell you when the energy crisis is going to happen, but I can tell you it's coming.
Is there an opportunity then in the exploration side since it's not happening? You said it's down 65%. So again, you're going the opposite direction of the
Yeah,
herd,
absolutely.
just higher risk.
I prefer less risky plays. There's guys. I mean, I went to a conference recently, and a guy's selling divided interest, fractional interest in a single vertical well. I'm like, please, if you're listening to this podcast, please do not do that. I mean, it's like, yeah, we're going to drill a hole straight down and we're going to hope we hit something and you own 10% of it. And by the way, they marked it up 10x when they're selling it to you.
Yeah. Well,
And it's like it's such a bad investment. And that's
let's
the thing about our space, the oil and gas space especially. It's just really sucky investments. What we try to do is institutional grade investments. So these are large oil fields. They're horizontal wells, very expensive wells operated by public majors. These are public companies like Devon, Marathon, Continental, et cetera. And they're producing assets. So this is a very, very, very different play, highly de-risked, right? We even hedge, we even do commodity price hedging, so we're
let's
wanting to kind of change the narrative. I mean, anytime you talk about oil and gas investment, everybody says, "Yeah, I did that," and of course they invested with Billy Bob, and it didn't work out, and big surprise.
Yeah,
So
let's talk about that because I feel like it's generally speaking, when we talk about typical real estate, whether it be a multifamily property, industrial, you can kind of wrap your arms around that, right? Like it's a
right,
tangible object. And I think oil and gas to your average, retail investor that's looking for passive income opportunities, you start talking about oil and gas, and it's probably a little more intimidating, right? It's not necessarily
right,
something they can wrap their arms around. Then you talk
yeah,
about Billy Bob, the guy selling fractional shares and all these other kind of snake oil
yeah,
salesmen, right? And my guess is that there's probably a good bit of that out there. How do we,
yeah,
what are the red flags? What are we looking for? When we're looking for
yeah.
a
You
solid
definitely
opportunity with a good group.
you definitely want to generally avoid vertical wells. You want to avoid drilling opportunities. There's just a lot. I mean, or the risk you're taking when you're drilling, right? You're taking
Yeah.
engineering risk, you're taking geological risk, and you're taking operator risk. and you're taking commodity risk, right? So you have just layers and layers of risk. What we're buying producing assets, okay, at 20 cap rates, 20% cap rates. We're not taking any risk except commodity price risk. If the oil price drops to zero, yeah, well, it'll suck. Although we are hedging, so we're even hedging that risk quite aggressively. But smaller operators, you really want to stay away from. Generally, you want to stay away from these fractional interests in vertical wells and these kind of things. But generally, just I would invest get your financial advisor or find a mastermind that is got some guys who have done it successfully. Because it is tough to find an operator. And that is generally true in all of private alts, right? The difference between the good operators and the bad operators is enormous,
Yeah, yeah,
right? You know this. And in the public markets, is the difference between the best real estate managers and the worst real estate managers who are all buying core real estate, by the way, is not is
right.
it's nominal. But in the private markets, the difference is enormous. And so, but it's where in the public markets, it's almost impossible to generate alpha, right? Outsized returns in addition to the market, above the market. In the private markets, it's easy to generate alpha.
Yeah.
Because in the primary way you do it is by operator selection. So hey, yeah, pick Aspen. I'll put our name out there because we're good at what we
Sure.
do. But hey, there's plenty of good operators out there. That you just want someone of size and someone who is got a lot of reputation out there doing this and has a track record of doing it.
What else do you guys have your hands in at the present time at Aspen
Yeah,
outside of oil and
another
gas?
one is private credit. We love private credit, right? In every real estate crash, the guys that make the money are the lenders, right?
Mm-hmm.
The lenders always do fine, and so we love being lenders. And Ben. Our chief investment officer. He was a banker by background, so we're wired for credit. We love credit, and so we started a private credit fund. We have a big income fund, $100 million income fund. This has been operating for 13 years, never missed a payment. It's audited, um, and pays really high returns. So
Is
we love
pri-
credit.
yeah,
And then another thing in the public markets, right? Good luck trying to earn income. I mean, you can take an income stock like a mortgage REIT, like what we own privately, what we run privately. It's a mortgage REIT lending company that we have. In the public markets, there's one called Annaly. It's a big one, and yeah, they'll pay double-digit yields, but over the period I looked at it, the price dropped 80%.
oh
So
boy.
the value of it's like your principal goes down. It's like, okay, it's hard to earn income. In the private markets, it's easy to earn income, through private credit. So we love private credit and we love industrial. We're big in industrial space. So and again, playing the big trend of the reshoring, which has been going on for a decade, and it's got at least 2 decades more running room. And reshoring America, the world is over globalized. The world has underpriced the risk of supply chain disruptions,
Hmm.
and that's now being repriced. And and so you're seeing huge amounts of reshoring and nearshoring happening, and this all needs real estate. So we're playing that by we have a huge industrial kind of development arm where we're doing our own. We're very good at developing. So and of course that's really not rocket science either. I mean, none of this stuff is rocket science, right? It's like you just go, you find the qualified people and you go do it. So
What's
so
what's
those
your
are
take
some of the
on the
verticals
multi?
we love.
I know you guys spent some time in multifamily as well.
Yeah.
Not at present, but I mean, what's your barometer tell you about the coming years? You see any opportunity coming down the pike for
Oh
you guys
yeah,
to dive
it's
back
a
in?
great time to be buyers.
Hmm.
But with that said, so we are underwriting a ton of multifamily right now, and I think we underwrote 70 deals last quarter and bought one.
Yeah.
So what's happened? The sellers have not yet come to Jesus on the pricing, right? They're still holding out their hope. And the truth is, if you can get stuff at real market value, it's a great time to buy. But it's very difficult to make great buys. And I am seeing a lot of deals. So because of our private credit fund, we lend pref equity on
Hmm.
multifamily. We're seeing a lot of deals that people are getting done and they're paying too much. They're overpaying. Every one of these deals, I'm happy to lend against it, but I would not put a dime of equity in any of the deals, or very few of the deals I'm seeing. So people are overpaying.
Interesting.
And I do think it's going to be a very rough few years for
Yeah.
multifamily, and we still have a few more rough years. We're going to see a lot of shakeout, and interest rates are going to remain high for a while. And I've been saying this for several years, that interest rates are not coming down. Inflation is not coming down like
Hmm.
people want, and there's reasons for that. There's kind of systemic reasons, not non-cyclical reasons, that those things are going to happen. Structural reasons
Yeah. What do you think the
that are not
multifamily,
changing.
what do you think real pricing should be from peak pricing? Is it, you think realistically it's a 25 to
I
30%
mean, I mean, yeah,
discount
you
from
want to
what
see
peak
it, see
was?
a 25 or
Yeah.
35% discount from the peaks, and of course it depends. I mean, right now, everyone is migrating towards Class A, right? And Class A, and so you're seeing Class C's, the greatest discounts on Class C's. I see the greatest opportunity in Class C, because there's workforce housing, right? And if you can get them at the right price, right, and people need a place to live, and as you saw in New York with the election that just happened, housing affordability is a very, very big deal. And so getting some Class Cs, I think it's a good time. I think there's greater discounts in Class C than there is in Class A and B. And so if you can get discounts, right, there's no such thing as a bad investment, Kevin. It's just a bad price, right?
There you go. I love it. I love
So if you can get a good price and it's in a Class C, then take it. It's really you make your money on the buy.
Yeah, no, I agree with that. I mean, I think the challenge with Class C is that, in the heyday during, the peak of it all, there wasn't very, the delta got so thin, between what C class was trading for to what A class was trading for,
Right.
and ultimately, so I think it's got a further way to drop
And
down
and
now.
now it's very wide. It's widening out, and C's are suffering,
Yeah,
and because an A and a B can always run a C out of business. They just lower their rents a little bit,
that's
competing
right.
with the C's, and the C's suck. They got nowhere to go. There's no place to hide. Great. It's terrible if you're a C operator. It's wonderful if you're a C buyer,
Yeah.
right? As long as you can convince the seller to sell it to you, at the price, So we're fine. We just bought a 100-year-old property in a beautiful part of town. And we bought it, I think, 20% below what the previous operator bought it for, and after putting in $7 million in capex on it. You know? So
Was that in,
those kind of deals are just going to be sweet,
yeah,
right?
yeah. I'm just
But they're
curious,
they're
that
they're they're
particular one, was it in special servicing or in pre-foreclosure, or, was it in trouble at that point?
no,
No?
I don't know.
Yeah.
Honestly,
No,
I'd have to
fair
ask
enough.
my team about that.
So let's switching gears a little bit here, Bob. Your book. I know we talked about it a little bit. Invest Like a Billionaire. It's not released yet. It's coming here in September. Talk to me about it. What can we learn by grabbing a copy?
Yeah, and you've kind of been hearing this passion for a while, but so if you look at the big boys, the billionaires, it's called Invest Like a Billionaire, and they make way higher returns than a normal investor, and they take less risk doing it. And so I cracked the code on how billionaires do this. So if you get a $10 million and you go to your financial advisor, they're going to put you in roughly a version of a 60-40 portfolio. 60% stocks, 40% bonds. And yeah, they're going to put their little tweak on it, but it's basically the same thing.
Yeah,
Do you know how many billionaires do that with their money? Not
probably next to
one.
none.
They're 20% in the public markets. They're 50 to
Yeah.
60% in private alts. And the reason they're in private alts is because they make higher returns, and there's less risks. And I have charts to show this. There's 70 charts in the book. I'm a data guy at the end of the day. I'm a total Mr. Analytical nerd. And we've gone through all the data here and pulled all the data. They're lower risk and higher return in general. And then when you have a portfolio of uncorrelated assets, so meaning
Hmm.
A is zigging when B is zagging,
Yep.
right? Well, the portfolio volatility is way lower, way lower. And so that's the key, is getting uncorrelated assets. And the only way to do that is private alts. And by the way, it's impossible to do it in public companies. because everything is correlated now and way worse than it ever has been. Ever notice when there's a red day in the stock market, everything goes red?
Yeah.
Explain that to me. Why if Amazon had a bad return, say, why does REITs go down, real estate investment trusts, right? Why, but they do. And it's nuts. It's nonsensical is what it is. And
What?
I can tell you
Yeah.
the structural reasons why it happens, but I'll bore you with the details.
But I think I mean even speaking to like we talked about multifamily. I think there's lots of LPs out there that have lost money over the last couple of years. But a lot of it, most of it ties back. My at least what I've gathered from investors that are in our various funds, most of it ties back to these LPs going hot and heavy into these just simply into multifamily. Maybe different
Right.
syndicators, but all into multifamily and not having a more diverse portfolio base.
You
So
you
back to your
must
point.
you must do this. And every asset class, I go into each of the seven main asset classes in detail. I point out their superpowers. I look at their risk return profiles, how they relate, and how how their superpowers operate, how to construct a portfolio that meets your needs. I also go into how they pay less taxes, the whole thing. Billionaires pay less taxes than everybody else. How to do all that, how to structure these things, and how to do due diligence on operators. Because the biggest thing in the private space is operator selection. That's
Yeah,
that's the
that's
biggest
right.
thing that will determine your returns. Is operator selection, and the second thing is allocation of uncorrelated assets. And those two things are the keys. In the public markets, I have a chart from JP Morgan I just love, and it shows the best operators of real estate investment trusts. So this is public real estate companies, right? The best guys and the worst guys. You know what the difference in return is?
Hmm.
1.5% between the best guys and the worst guys. Why? Well, because they're basically doing all the same strategy. They're buying core, and they're just sitting on it, right? And then in the private markets, the best guys, like the 75th percentile performers, double the
Hmm.
returns of the public guys, double. And the worst guys, the 25th percentile managers, lose money, no returns.
Yeah, I mean, would you
So,
would would
so,
you
so the
attribute that
way
to
the
just
key you'll live and die on operator selection,
yeah,
and that if that scares you, then great, be scared and don't do this. But the truth is, you can learn how to find good operators. There are lots
that's
of great
right.
operators out there,
I
and
think I mean I think it can be attributed to I mean just literally you talk about the the public markets, you're talking about sophisticated operators. I mean well-trained sophisticated operators, whereas in the private markets, I mean there's a major delta. There's definitely a lot of sophisticated, very advanced, with more of an institutional mentality, but ultimately in the private markets. But then you've
definitely,
got you've got Billy Bob, like you talked about, right?
yeah.
That
There's
is
Billy Bob's always there.
yeah, Billy Bobs are always there. So really, you're looking for the right
Yeah, well,
jockey.
and so the REITs can't do the more innovative strategies. So the value add strategy, a REIT can't do it because they're required by law to distribute 90% of their returns.
Hmm.
So they cannot take cash flow and do capex investments. So they're with the most vanilla strategies. Where in the private markets, we're not limited by these kind of constraints.
That's right.
We can do things that are opportunistic. I'm going to buy Miami beachfront condos for $35,000 as long as I can do that, and you can just make incredible returns in that
Yeah.
these kind of times.
So the book, it's going to be released. I think you said September this year,
September
correct?
2nd, yeah.
Okay, September 2nd.
So go to thebillionairebook.org and don't wait till September 2nd. Go to thebillionairebook.org and go. You can purchase it on Amazon, and as soon as you upload your receipt, you will. We have a master class where we'll give you. I'll give you my top 25 investments or sorry, my top investments for 2025, and give you a master class on the book and seven things your financial advisor will not tell you. It's a really good, and you'll love
yeah.
this. And it's all free, and you'll get the first six chapters of the book
All
pre-release
right.
in a PDF
Fantastic.
as
Guys, I'll
well.
get
So
that in the I'll make sure that's in the show notes. And then Bob, as we wrap this up and round it out, what's something that you're really excited about? I'm excited about the book. I'm sure you're excited about the book as well. But aside from the book, what are you really excited about here in the next 12 to 24 months? What keeps you up at night in a good way?
yeah, I'm honestly super excited about these. these verticals we're in. I'm very excited about industrial. I mean, we're seeing huge amounts of activity right now, and the Trump, Trump is only accelerating this. And
Hmm.
oil and gas is the same. I think it's just an incredible buying opportunity. And I would say the same with multifamily if you have like if you can find the deals, So yeah, very,
Yeah.
very excited about that. I mean, I want to see interest rates come down. I think that's gonna make a lot of things easier. But I look at the data and I'm not convinced they are. And if you look at the bond market, the interest rates are driven by bond markets, and the bond markets. I mean, the bond market right now is 6 times larger than it was before the Great Financial Crisis.
Wow.
6 times more debt has been issued by the United States,
Yeah.
and that's because of these massive deficits. And so it's a supply and demand curve. So who's going to buy all this debt, and are they going to be satisfied with these low yields? No, want higher yields. So that's why there's a structural problem here, and so I'm concerned about that. I'm concerned about can they solve the debt problem here? And I'm not a conspiracy theorist, and I'm not a catastrophist, right?
Yeah.
We're not going to see an explosive crash. We're going to see just painful high interest rates and painful inflation.
Well, I think the important point there to be made about high interest rates is that you talk about finding the right sponsor, finding the right jockey, right? Getting with a group that can find the right alternative investments and pick the winners is that there's still opportunity out there today. There's
Oh
opportunity to
yeah,
win and make big returns, and so one can
yeah.
argue that if you find the jockey that's finding those great opportunities and great returns, and what would
There
seemingly be a
always
more
is, Kevin.
challenging market, that's where you need because it should only get better from here on out.
There
One,
always
one
is.
can
I go
argue.
to these real estate conferences, and a lot of times I'm in the multifamily room, and they're all got this bleak look on their face, like they're looking at the banquet table and it's all empty in front of them. There's nothing, and then but if they turn around, they see 10 tables that are full and rich. It's like there's always something that's
Yes,
working.
that's right. That's right. Well, Bob, it's been a pleasure having your show. I appreciate you coming on. For those that want to learn more about Aspen Funds and the different offerings that you have, where's the best place to track you down?
AspenFunds.us.
All right. All right. Fantastic, my friend. Well, appreciate you coming on. Excited about the book. I'll go over there to Amazon and grab a copy. Well, not grab a copy, but we'll grab a pre-release copy now. And you enjoy your time in Breckenridge. That beautiful background there. For those that are watching the video of this, you see those beautiful trees. That is not a fake background. That is Bob's real background. That's his backyard. Beautiful area. So, my friend, I appreciate you coming on the show. Thank you.
Yeah, it's so appreciate being here with you, and wish all your listeners the very best and a prosperous remainder of the year and next year, many years to come.
All righty. Guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care now.